All right, then there's aerospace. I mean, no, nothing is more important to this industry than getting that Boeing 737 MAX back in the sky. Periodically, Boeing stock will get hit by negative publicity. Can you recall a single positive story about this company in ages? But I think it's worth hanging in there, waiting for the FAA to give them approval, because there's so much demand for aircraft that the stock will take off like a rocket when that happens. And those are just the tip of the iceberg. I have another dozen examples in my head, a dozen examples of stocks that simply don't trade on earnings or sales anymore. When there are only a few of these names, it was fine. But these days, there are so many of them that it's become much harder to parse what's going on in the broader market. We like earnings per share. We like revenues. But this, like, all these new investigations per share, hard to get your arms around. Now, what do you do if you're hostage to one of these odd metrics? First, I think it's only safe to own one or two of these, because if you have too many of them in your portfolio, it's going to drive you crazy. Second, if you want stocks that are more straightforward, you can always buy some dividend names with big yields, the ATTs of the world. They'll let you sleep at night. The important thing is that you know how much agita you're willing to put up with. It's called suitability. It's much easier to own a dividend stock than something that trades on federal investigations per share. I'm not saying you shouldn't own these stocks with non-traditional valuation metrics, but it requires more patience than owning something normal. And you pick up the paper and you're in the paper every day. Finally, and this is the big one, you have to be skeptical of markets, entire markets, where more and more stocks are valued on something other than earnings. This is what happened during the dot-com crash. You had tons of companies that were trading on eyeballs and page clicks. Needless to say, that suspension of rigor did not end well. The more stocks that trade on weird metrics, the more likely it is that the market's overvalued. Right now, I still think the bulls have the upper hand. They're winning September for once. But here's the thing. You can only go up for so long based on something other than earnings before we have to accept that valuations have gotten out of whack. In other words, this is not a normal market, so we do need to be careful. At least we don't have to worry right now about WeWork. Yeah, because apparently that one's about tequila per share, judging by how much tequila flowed in the office when CEO slash King Adam Newman was on top of his game. But with 9 investment bankers in the running the books and being on the hooks, you better believe they'll find a way to get that metric in front of us. The bottom line, when we had only a few stocks that were traded on something beyond the 4 walls of the spreadsheet, well, that was fine. But when you have dozens of stocks, including entire sectors, that have become partially unhinged from their sales or earnings, well, I have to tell you, you got to proceed with caution.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.